Hello traders, Igor here, MrTOPTICK.com. Welcome back to the channel. Welcome back to a new year. Hope everybody had a good holiday. Today is Friday, January 6th, 2023. We're going to talk about one of the first 112 bear traps that is expiring today. This is one of several others that I currently have running as a campaign. I open these every week on Tuesday or Wednesday, looking for about 56 to 60 days until expiration. Just a little background on typical setup for this trade. This is a 30-point wide put debit spread financed by a sale of farther out of the money naked puts. It's 2 naked puts for every 1 put debit spread. This trade here that we're looking at, this is a January 6th expiration. The trade was initiated back on, I believe this was 52 days ago. And it didn't really require a whole lot of management, so to speak. We did make one adjustment, and this adjustment was made to the upside. We're going to go through steps that were taken as part of the management of this trade. Hopefully you'll find this useful. If you do, please give it a like. Share this video with somebody that you think could also find this useful. And if you haven't subscribed to our channel, please do so if you would like to get exposed to more content similar to this. So we're going to start off with the very beginning where this trade was initiated. So the trade started off as a typical 112. This trade was initiated on Wednesday, November 16th. This trade had 51 days until expiration. We went ahead and we bought to open 38.60, 38.30 put debit spread. And this put debit spread was financed by a sale of 32.50 puts, and these puts were sold naked. A couple of things real quick. Yes, this trade does require quite a bit of margin if using SPX. As an alternative, you can look at options for SPY. You could also look at XSP, which is a smaller contract, very similar to SPX. It does not have as much liquidity from what I have found, but I am running some tests, and this could potentially be a viable solution for those that cannot trade S&P 500 contracts such as SPX. Now, there are a large number of traders within our community that substitute SPX options for /ES, which are options on futures. They also use MES for micro contracts. So there are definitely alternatives out there. Everyone has to kind of figure out what works best for their account size, risk profile, and so on. Another thing I want to mention is that this trade does carry a ton of risk, a lot of risk to the downside, not only because we have potentially an unlimited risk to the downside. I mean, reality is price could only go down to 0. So to say that it's unlimited is not really true, but the risk is real and there's a lot of it. Also, another risk that a lot of traders may not give enough attention is exposure to potential explosion in the volatility. This is a negative Vega trade. This is a 5 lot, and a 5 lot is carrying almost negative 1,300 Vega, which means that this position is going to lose theoretically about $1,300 for every 1 point volatility is going to increase. And as we already know, when the market starts to go down, volatility typically goes up. So now in this trade, not only are we positive delta, which means that we're going to get hurt on the way down from the delta or directional point of view, we're also going to probably get smoked by a rise in implied volatility. So these things need to be considered before taking any trades. If you're not familiar, if you're not sure what I'm talking about right now, it's probably best to get some education. There's a lot of information out there online. good, high quality free content. Please be aware and understand where the risks are, what could potentially go wrong, and more importantly, have a plan, what you're going to do before something happens. You don't want to manage positions when you're in the middle of a crisis. So with that being said, this was the trade that we initiated. 51 days until expiration. We initiated this trade for a net credit of $10.40 per one lot. This is a 5 contract or 5 lot trade. This trade did not require any adjustments until this was December 20th. So let's go forward and have a look where the market was on December 20th, what this position looked like, and I'm going to talk about an adjustment that I had to make. So now we go to December 20th. This is 34 days in the trade. The price has come down about just over a half of 1 standard deviation. And surprisingly, right, the price has come down half of 1 standard deviation. So it's not an outlier move. And obviously, we would assume that on the way down, implied volatility is going to increase. In fact, my software shows that implied volatility has fallen about 9% from when we took this trade. So we had a couple of things going for us. Number one, price is moving inside of the trap, right? We have a put debit spread that's increasing in value. We have an out of the money short puts that are losing value, right, due to time passage or premium decay. So the price is moving slowly into the trap, and we have volatility, overall volatility is coming out. So we have a couple of things going for us. This is 34 days in the trade. We are now inside the trap. We have about 17 days to go. And now we have to kind of figure out, what are we going to do next? I did put out a note to members of Income Navigator about my plan, how I was going to manage this trade. Let's have a listen. This is an adjustment to S&P 500 112 bear trap. This is a January 6th expiration cycle. So we are currently holding a position, which is a standard 112. We are along 3860, 3830 put debit spread, and we are short the 3250 puts. This position is currently showing a decent profit with about 17 days until expiration. S&P has come down quite a bit in the last week or so. Looks like we are finding some buyers today. Not sure where we go from here, but if we do trade higher, there is a chance that price may come outside of the bear trap. We can go one of two ways here, leave it alone and do nothing. So if the S&P is going to settle somewhere inside the bear trap, that would be great. If the S&P goes outside of the trap, it still will be a profitable trade. What I'm going to do here is I am going to pick up a call debit spread to flatten out my net delta. So looking at my Greeks here, I'm currently short about 30 delta, buying 3 of the 3840, 3870 call debit spreads. This is currently going for about $14.80 each. This is going to take my net delta from minus 30 to minus about 8. So if we are going to push higher, that's fine with me. There's going to be a profit. Obviously, it'll be a more profit than if I was to not make this adjustment. On the flip side, if we do push lower, me spending $14.80 for each of the 3 call debit spreads obviously is going to take away from some of the potential reward that I would see inside of 38.30 or lower. So there are 2 sides of this coin. We can lower our potential return inside the trap, so that's a negative, in the exchange for increasing our potential return outside of the trap. Implied odds are pretty much the same. Our break even doesn't really change a whole lot as long as we don't crash. We don't trade below 3250 inside of the next couple of weeks. So for right now, I'm just going to make this small adjustment, slightly neutralize this position, and there is an outside chance that we pin 38.60 in 17 days. Obviously, my call spread is going to expire worthless. All of my puts are going to expire worthless. And I will still end up with a slightly higher profit in that case, if relative to if I was not to make any adjustments whatsoever. So the trade here, I'm buying to open 3 of the 38.40, 38.70. It's currently going for about $14.80 debit. I'm going to try to get in for as little as possible. I'm going to go at 14.70 and work my way up towards the mid, which is 14.80, 14.85 right now. And probably going to leave this trade alone, hold it for the next 17 days into settlement. So this was the adjustment. We picked up 3 of the 30-point wide call debit spreads to kind of rebalance our net delta. And also in the event that the price was going to trade higher, we wanted to, instead of giving up potential profit in this trade, we wanted to lock in some of that profit. Let's go to where we are today. Today is the expiration of this trade. And with S&P currently trading at around 3,900, you can see that our call debit spread that we had purchased, which is a 30-point wide spread, is now in the money. Obviously, S&P 500 options, SPX options, are cash settled, so we don't have to worry about getting assigned on any of the short options here. Everything is going to be cash settled after the close. So we can try to figure out exactly where this trade is as far as the P&L goes. So as we know, the price for the original 112 bear trap, it was $10.40 credit. So we get to keep that, right? We have 38.60, 38.30 put debit spread is going to be worthless at the close, and our short 32.50 is going to go out worthless. So the 112 bear trap that we had picked up initially is going to expire worthless. We get to keep $10.40 credit that we had collected. The adjustment that we made, which is a 30-point wide call debit spread, is 30 points wide, which means that at the close, right, we have about a half hour left in this trading session. At the close today, assuming that 38.40, 38.70 is going to hold and S&P is going to remain above 38.70, this 30-point wide call debit spread is going to be worth $30. I paid $14.60 debit for it. Now we can do some real quick math here. It's worth $30 at the close. I paid $14.60 for it. So I'm making $15.40. And this does not include any fees or commissions, just to keep it simple. So $15.40 profit multiplied by 3 contracts, that's $4,620 profit on 3 of the 30-point wide call debit spreads. Now, if we wanted to equalize that on a 5-lot position that we're carrying, right, we divide that by 500, which means that I am making an additional $9.24 on top of the $10.40 credit that I initially collected for the 112 bear trap. We can figure out what our P&L today is. We multiply 9.24 by 500. We have $4,620. And if we add the original credit that we had collected, we're totally making $19.64, which puts us at a total profit for this trade, $9,820. So now, one thing I wanted to point out here real quick is that a lot of times we talk about making adjustments on the downside because that's where the risk is. But on the upside, we talk about potential adjustments when we get into the bear trap. And the bear trap is really the area, right, inside of the put debit spread and the naked puts that are short, right? This is the bonus. This is where we make the most money. And once we get into the trap, there's a chance that the price may run away and we are potentially going to give up any of the potential reward inside the trap and just have to settle for the initial credit that we collect upon entry into this trade. Now, we don't have to just watch price run out from the bear trap and settle for a smaller profit. There are ways such as, picking up a very simple 30-point wide call debit spread to potentially lock in some of the profit, right, in exchange for lowering our reward inside the trap. So it's a give and take game. I think this is a perfect example to show you how being a little more proactive could slightly increase your profit. And I think overall, if you have enough of these trades throughout the year, small incremental adjustments that will result in smaller increase in profitability, they will add up to a pretty decent difference between being proactive versus, slap a trade on, do nothing else unless you hit your stop loss. And this is particularly when it comes to 1-1-2 bear trade setups. I hope you found this useful. If you enjoyed this content, please give it a like, share this, and subscribe to our channel. Until next time, if you take care of the risk, the profits will take care of themselves.